Welcome to Talkikers. Today we're breaking down the latest quarterly results from facility services giant ABM Industries.
So, here's the big question on everyone's mind. A solid growth story just hit a bit of a snag. Is this a warning sign or maybe a buying opportunity? We've got a classic mixed bag here. Strong sales, but weak profits. So let's dive into the numbers and see what's really going on behind those headlines.
All right, first up, the quarter by the numbers. And really, the theme here is strong top-line growth meeting some serious bottom-line pressure. It's a real tug-of-war. Okay, so check this out. 5.5% organic revenue growth. That's a big number. In fact, it's the strongest organic growth ABM has posted since way back in the fourth quarter of 2022. So, on the surface, this tells you one thing. Demand for their services is really healthy.
But, and this is a big but, the bottom line tells a completely different story. Adjusted EPS came in at 83 cents. That's not just below what Wall Street was expecting, it's also a step down from where they were this time last year. And this really lays it out perfectly. Look at the year-over-year comparison for Q1 EPS. We went from 87 cents last year down to 83 cents this year. So even though more money is coming in the door, less of it is turning into profit. That's the puzzle we've got to figure out. So, what's causing this split? To get to the bottom of it, we've got to peel back the layers and look at the individual business segments. It's really a tale of two segments, as you'll see. Okay, take a look at this table. The story is right here in the numbers. Revenue growth, pretty solid across the board, right? Aviation is up 10%, technical solutions up a whopping 14%. But then you look at the operating margin, and wow, it's all over the place. The absolute standout is education, with margins expanding by 320 basis points. That's huge. But on the flip side, technical solutions, their margins got nearly cut in half, a drop of 450 basis points. That's the problem child right there. And you know what? To their credit, management didn't try to hide it. The CEO, Scott Salmer, was very direct. He said, and I'm quoting here, "Our first quarter shortfall was predominantly concentrated in technical solutions, impacted by project timing and service mix." So they're pointing the finger squarely at projects getting delayed and a less profitable mix of work in that specific segment. So let's break it down into the good and the challenging. The bright spots are pretty clear. Aviation revenue is flying high at 10% growth, thanks to strong travel demand. And education, like we saw, had just incredible margin expansion. But then you have the pressure points. Those technical solutions margins getting hammered by weather-related project delays. And on top of that, some newer, lower margin contracts in their other big segments also weighed things down. The key word here that management wants you to remember is temporary. All right, so with the shaky start to the year, what does this mean for the full year outlook? Let's get into the guidance and what investors were really grilling management about on the call. So here's the kicker. Despite that Q1 miss, management is holding firm on its full year guidance. They're still calling for adjusted EPS between $3.85 and $4.15. How? Well, the path is basically a second-half story. They're banking on those delayed projects getting back on track, and they expect margins to be heavily weighted to the back half of the year. They're telling investors, trust us, we have a plan, and it relies on disciplined execution. As you can imagine, the Q&A with analysts was all about this back half story. They were really pressing management on the path to that guidance. Can you guys really pull this off? Other key themes came up too. Management's being cautious on the macro environment. They're also pausing big stock buybacks for a bit to pay down debt from a recent acquisition. And here's a really interesting tidbit. They're seeing surprisingly stable labor conditions, no major wage pressures. That's a real positive that you're not hearing from a lot of other companies right now. So we've gone through the numbers, we've heard from management. What does this all mean for the stock? This is the next call, our rating on ABM Industries. Okay, so our rating is market perform. Here's why. That solid underlying business, the organic growth, it's absolutely there and it's encouraging. But, and it's a big but, everything now hinges on that back half recovery. That introduces a ton of execution risk. So for now, that keeps us on the sidelines. It's a show me story. And what about next quarter, Q2? Well, our prediction is that revenue will see some modest growth. That's the good part. But EPS, we think it'll be flat to slightly down again as that margin recovery slowly starts to kick in. So what does that mean for the stock price? We expect it to be pretty range-bound. It's probably going to tread water until the market sees real proof of that turnaround. All right, now for our trade idea. The thesis is simple. Management is confident, but the market is skeptical. The setup?
If Q2 starts to show that margin stabilization in technical solutions and management sounds confident about Q3, the stock could really take off. So what's the trade? You could consider selling some short-dated, out-of-the-money puts. Basically, you're collecting a premium because you believe the stock isn't going to totally collapse. And hey, if you're wrong and the stock does dip, it defines a more attractive price for you to buy in. Now, the risk, of course, is that a market downturn or a failure to execute on their plan just blows up the whole thesis. And remember, this is not financial advice. So that leaves us with the big question. Management has laid out a clear turnaround plan. But will their execution in the coming quarters reward investors who are patient, or will it end up revealing some deeper issues? The story is now all about execution. The next chapter is theirs to write. This is not financial advice.